Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. Investors are trading a market with no historical blueprint. Those are the words of my next guest, Chris Weston, Chief Market Strategist at IG. Chris Weston, many thanks for taking the time to chat with Dukascopy TV. Always a pleasure to see you.
Pleasure to be here.
Okay, now we're going to turn things around and talk about China, because there isn't a huge amount else to talk about. Is the kindest thing really China could be doing for global markets is going on that holiday at present?
Well, yes and no. I think we want clarity about what's actually happening in China. I don't see the volatility which we've been seeing in multiple global assets being a reflection of a slowdown in China. I think the market's pretty au fait with the fact that the Chinese are engineering a slowdown, and next year they're likely to grow at 6.5%. I don't think that's a major problem. In fact, it's probably quite a good thing that we are seeing this level of deleveraging coming through. What we're concerned with, and I think the issue why global markets are seeing such exasperated moves, apart from the fact there's other issues as well as China, is the idea that the market may have lost the sense that the various officials within China, whether it be the PBOC, the CSRC, the regulator, or the government, are being reactive. They're fighting fires effectively with new policy initiatives, which seem fairly extreme to some people. And I think what I mean by that is that every time we see a major issue like capital outflows and what that does to the financial tightening of financial conditions, we see them restricting what's happening with CMY forwards, for example. If you see an issue with margin debt, we see them curbing back on margin debt quite categorically, and we've seen a 55% decline in that. You see all these major issues which they've put in place, and now they're trying to look at what the negative consequences are, and then suddenly they put a new cap on that. And I think the market's just very skittish about what actually happens with China longer term with these new policy initiatives that seem to be placed in the markets every single day.
Because this is the thing, if we look at these global concerns that investors are getting themselves riled up over, until sort of this China market madness, the US was on target for that September rate hike. Are these fears being overstated?
Well, I think first of all, there's a lot more at play that's happening within these markets right now, and I think the emerging market side of things has been in play for quite some time. It's not just the China issue. We know there's been huge withdrawals from emerging market accounts for quite some time. We know. I think that the Bank of International Settlements put out a recent statement talking about the level of investment that had been taking place and borrowing, I suppose, in US dollars to fund the carry trade. So they've been borrowing in cheap dollars with obviously their zero interest rate policy, the asset purchase program that they've had for many years. And then they've been using that to buy high-yielding assets in emerging market nations. That's obviously being unwound at a rate of knots. And as that trade-weighted dollar increases, not just the dollar index that we all know and talk about, but the trade-weighted dollar increases, it's putting a huge burden on a lot of these emerging market countries. So I think that's a significant play. The withdrawal of funds from emerging markets is definitely in play at the moment. Earnings, I suppose, is another big situation. If you look at earnings in US and in Australia, in parts of Asia, they are falling away. They're certainly topping over, and I think some of the technicals have got quite shaky. Then you hear about some of these big funds in the US which work on a volatility measurement. So they've diversified into multiple asset classes to try and spread the diversification, but they work on volatility measurements. And that's exactly what I think we saw last week. A lot of these big hedge funds who have these diversified assets and are leveraged very much to what's happening in volatility. As those volatility picked up, they had to dump and reposition themselves, and they dumped a lot of assets into the market. And I think that's what exasperated the volatility. So I think what we saw with that volatility measurement has really hurt things as well. So I don't think this is specifically a China issue or an emerging market issue. I think it's very hard to pinpoint one thing. Is it the correction that we needed to have in a long-term bear market? Well, I think that seems to be playing out at the moment. But China's just one cog within and one piece within a larger list of concerns here.
If we're looking at sort of the cards falling into place, then obviously we are looking at the US Fed, we are looking at what the PBOC could do next. It seems to be almost long-term economic aims versus short-term market situation. Where have they got to go next?
Well, I think the number one aim for them at the moment is stability in their financial markets. I don't sit in the camp that there's a huge feedback loop between the stock market and the real economy. Some people have said that if we see a further collapse, it's going to really impact real wealth in China, and that's going to crimp consumer spending and obviously have a knock-on effect on growth. Now, I think that there's a very high savings rate in China. I don't think 40% is one of the highest in the world, if not the highest in the world. That's going to mitigate and cushion some of the falls in the stock market. I think it's about 12% of households in China actually own equities. The balance sheet of as a percentage of their domestic portfolio is about 25%. So it's fairly small, and a large amount of the actual equity turnover is concentrated in a very small group. So I don't sit in the camp that this collapse that we've seen, the 45% move since June into August, is going to have a massive implication on real economics within China. But I think they've made it pretty clear that they are looking for stability. Now, whether that stability is through stopping people from short selling and labelling them manipulators, whether it's from telling the press that they can't write negative articles, stability is the number one thing now. And I think the secondary tier is what they're doing to try and stop capital outflows of China as well. So they seem to be the two natural situations. I think unemployment's another thing that they're looking at very closely as well. Whether they get stability in that stock market longer term is obviously yet to be seen. I still sit in the camp that there's probably some further downside in this market, but I don't believe that it's going to have a catastrophic effect on the Chinese economy.
So if we kind of take into account sort of everything that we've discussed, that high volatility situation, are you seeing that Fed hike in September then?
No, in a word. I think the market's pricing at about a 35% chance that we see the Federal Reserve raise. And for me, if they do raise, they're going to do it very, very gradually. I think it would send the markets into a bit of a panic, to be honest, if they raised in September. Saying that, I think if the Federal Reserve can sell it to the market, then it could be considered quite hawkish that the world's biggest central bank are looking to raise rates. My base case is that they're going to do it, and they'll probably do it in September. And there's a possibility they may well only do it in 10 basis points. There's a possibility they can just give themselves a small incremental step and move in that regard as well. But I think we need to be pretty clear about what's actually happening in the markets at the moment. If you take a step back and actually say, what is causing all of this? And I think you've got to say there's never really been a historic blueprint for what we're seeing at the moment. As traders and investors, we're always trying to compare what's happening in volatility now relative to other events, whether it's emerging market 1997, whether it's the GFC. We've never had a historic blueprint like this. We've never had an example like this where, so many central banks are expanding their balance sheet or have expanded their balance sheet by such an aggressive amount as relative to GDP, where we've had zero interest rate policies for such long periods of time, where we're getting liquidity withdrawals from emerging market funds. But at the same time, the world's biggest and most influential central bank is looking to tighten rates on a solo mission. That's not a blueprint we can relate to, and I think that's what's creating quite a lot of the volatility in the market. So, look, I think the Fed really do want to be in a position to raise rates. I think they want to do it as soon as possible, and I think they want to do it very, very gradually. I just don't think with the volatility we've been seeing, it really does mitigate them from doing it in September. They're a cautious bunch, and I think they'll probably look to do it, if they do it, in December.
I think as we head into sort of the Q4 season, it's really still all to play for. Chris Weston, thank you so much for your comments today.
Thank you for having me.
Always a pleasure to receive Chris Weston's comments. That is all we've got time for right now. However, do stay tuned, as the Dukascopy TV team will be bringing you plenty more exclusive interviews and analysis. For now, though, it's goodbye.